Hello traders, welcome back to our video. Today maybe we will discuss something different, not like other videos that just discuss one topic correlatively. For this video, I will invite you to discuss about next level trading, which consists of 4 subtopics. Should I change my trading strategy? Trade on other currency? Reasons why you should join for this community and news that matter. Don't forget to invite your friends, grab your coffee, and let's get for the first topic. As a forex trader, encountering periods of inconsistent performance or drawdowns is not uncommon. During these challenging times, you may find yourself questioning whether it's time to change your trading strategy. Changing strategies can be both enticing and risky, as it requires careful consideration of various factors. In this video, we will explore the key aspects to evaluate before deciding to change your forex trading strategy and provide a simulation to illustrate the thought process involved. Before considering a strategy change, it is essential to assess your current trading approach thoroughly. You can view these points. Firstly, is the performance review. Analyze your trading performance over a significant period, considering both winning and losing trades. Identify whether the strategy's performance is consistently profitable over time, or if it has experienced prolonged drawdowns. Secondly, strategy rules. Review your trading rules and plan to ensure you have been consistently following them without impulsive deviations. Determine whether your strategy is well defined and has an edge in the market. Thirdly, market conditions. Consider whether specific market conditions have adversely affected the strategy's performance, such as raging market or high volatility. And the last, emotional discipline. Evaluate your emotional discipline and decision-making during trades. Determine whether loss resulted from emotional reactions or adherence to the strategy. Let me give you an example of evaluating the strategy before you change it. Let's assume you have been trading using a trend-following strategy based on moving average and price action. Over the past 6 months, your strategy has experienced some challenge, resulting in a series of losing trades and a drawdown in your trading account. Upon closer examination, you'll find that your strategy performed exceptionally well during trending market, but encountered difficulties in choppy, sideways conditions. During these periods, you sometimes deviated from your strategy out of frustration, leading to losses that could have been avoided. So, what's the next thing you should do after evaluating your strategies? After assessing your current strategy and reviewing your trading performance, you must weigh the pros and cons of changing strategies. Identify market conditions. Recognize whether the shortcomings of your current strategy are due to specific market conditions. If the strategy is sound and has performed well during certain periods, it might only need optimization or adjustment for different market scenarios. Trading psychology. Evaluate your emotional discipline and ability to follow your strategy consistently. If your losses stem from emotional reactions, focus on improving your trading psychology rather than changing the strategy. Learning curve. Changing strategies entails a learning curve. Consider whether you have truly backtested and understood the new strategy, and whether you are prepared to invest time and effort in mastering it. So, that's some points you should know before you change your trading strategy. Let's move on to the next discussion. Alright, let's talk about the next topic. Diversifying your portfolio or trading other currencies. Some of you are still not diverse in your portfolio right now, and it is very common for many traders. But diversifying your portfolio can give you many benefits. First, diversifying your trading portfolio beyond your common currency can reduce risk and enhance overall returns. Correlation among currency pair varies, which means that when one pair experiences volatility, another may remain relatively stable. By holding position in multiple currency, you spread risk and protect your investment from significant losses in case one currency's value plummets. Second, trading foreign currencies opens doors to global economic opportunities. Different countries and regions have distinct growth prospects, economic policies, and geopolitical landscapes, all of which impact currency values. By engaging in cross-currency trades, you can capitalize on promising trends and events worldwide, thereby expanding your profit potential. Third, volatility in the forex market presents ample opportunities for traders. By diversifying your currency pairs, you can take advantage of various volatility levels and find setups that align with your risk tolerance and trading strategies. Increased volatility may lead to more frequent and favorable trading opportunities. Fourth, remember, each currency pair may suit different trading styles. While major pairs often provide more stable trends, assorted pairs can offer higher volatility, creating favorable conditions for day traders and scalpers. This diversity allows you to tailor your trading approach to the unique characteristics of each pair. Fifth, trading currency from emerging markets can be particularly appealing. Emerging economies may experience rapid growth and present higher interest rates, which can lead to substantial currency appreciation. By exploring this currency, you can tap into the potential development of emerging market economies. And sixth, in times of economic uncertainty or geopolitical instability, having exposure to diverse currencies can act as a hedge. When your domestic currency is facing depreciation or inflation, positions in stronger foreign currencies can offset potential losses, preserving your purchasing power. But before you start trading on other currencies, you should be settled yourself first and be prepared. Before trading a new currency, make sure to understand the underlying fundamentals influencing its value. Factors such as economic indicators, interest rates, political stability, and trade balance can impact currency prices. Stay informed about the economic outlook and news of the countries related to your chosen currency pairs. Remember, each currency has different volatility levels. Although diversification can mitigate risk, it's essential to be aware of currency correlation. Some currency pairs may have in tandem to the shared economic path or other factors. Understanding this relationship helps you make well-informed trading decisions and avoid overexposure to highly correlated assets. For example, if you want to trade US dollar and South Africa rand, you should assess both countries' economic and geopolitical events. In recent times, some African countries have had a bad perspective toward the US and include South Africa in its BRICS agenda, so it would influence the market conditions. When venturing into new currency pairs, start with smaller positions to limit risk. Use a demo account to get familiar with the specific behavior of the currency pair, its historical performance, and how it reacts to various events. Gradually, increase your exposure as you gain confidence and experience. Don't forget to learn and adapt. The forex market is ever evolving, influenced by global events and changing economic landscapes. Commit to continuous learning, stay updated on market development, and be prepared to adapt your trading strategies accordingly. Okay, that's for the first your portfolio topic. Let's move on to the next topic to bring your trading to the next level. Okay, this discussion maybe is optional for you, but also mandatory for you. Sounds interesting, right? Right now, the discussion will talk about some reasons why you should join the Forex community. There are 9 reasons why you should join Forex communities. Number 1, the community is a place to learn. Forex communities offer a treasure trove of knowledge and expertise. By engaging with the other traders, you can tap into their experience, strategies, and insights. The community provides a supportive environment to ask questions, share ideas, and learn from each other's success and failures. Number 2, the community can give you some networking opportunities. Connecting with the like-minded individuals in the Forex community expands your network within the trading industry. This networking can lead to valuable collaborations, partnerships, and even potential career opportunities. Number 3, emotional support. What? Emotional support? Is there a psychologist in the community? No, it's not like that. Forex trading can be mentally and emotionally challenging, especially during periods of market volatility or losses. A community of traders provides emotional support, encouragement, and motivation to stay resilient during tough times. Maybe you can discuss your messed up mind with another trader or just spill out your thoughts in community threads. Number 4, can give you market analysis and trading signals. Within the Forex community, traders often share market analysis, trading signals, and setups. Access to this information can be valuable resource for making informed trading decisions. Sounds good, right? Number 5, bring up accountability and discipline. Being part of a Forex community fosters accountability. Sharing your trading goals and progress with others encourages discipline and commitment to your trading strategies. And number 6, stay updated on market news. In the fast-paced market like Forex, staying informed is crucial. Forex community acts as a platform for real-time updates and economic news, central bank decisions, and geopolitical events that can influence currency pairs. Number 7, can give you diverse perspective. Forex communities consist of traders from various backgrounds and levels of expertise. This diversity of perspective can broaden your understanding of the market and help you see trading from different angles. Number 8, avoiding trading isolation. Trading can be a solitary activity leading to isolation. A Forex community provides a sense of belonging, fostering camaraderie among traders who share a common and passion for the market. Number 9, you can learn collaboratively. Collaborative learning is one of the most significant benefits of being part of a Forex community. You can participate in webinars, workshops, and group discussions to enhance your skills and gain new insights into the market. But before you join a Forex community, let me give you some useful tips. Be respectful. Treat other members with respect and courtesy. Differing opinions are normal, but disagreements should be handled constructively. Contribute and share. Don't be afraid to share your knowledge and experience. Active participation enriches the community and encourages others to do the same. Verify information. While communities can be a wealth of knowledge, always cross-check critical information before making trading decisions. Avoid over-reliance. Rely on your analysis and judgment rather than blindly following other threads or recommendations. Use multiple platforms. Explore various Forex communities and platforms to find the one that best suits your needs and trading style. Stay positive. Positivity breeds success. Focus on learning from mistakes and celebrating successes, both yours and others. So that's some reason why you should join Forex communities. What do you think? Are you interested to join the Forex community? Alright, let's move on to the last topic from this video. Okay, we jumped into the last topic of this video. It's about the news that matters. This section maybe is for you who are unusual to analyze the news or do a fundamental analysis of your trade. As I said earlier, in some previous videos, fundamental analysis is very important for your trading decisions. So just relax, let me explain to you the news that matters. In the fast-paced world of Forex trading, information is power. News events play a pivotal role in shaping market sentiment, influencing currency prices, and determining trading opportunities. As a Forex trader, it is crucial to differentiate between the news that truly matters and the noise that can lead to unnecessary risk. In this article, we will explore the key news events that have a significant impact on Forex trading and provide valuable tips to help traders stay informed and make well-informed decisions. The first kind of news is economic indicators and data releases. Economic indicators are fundamental to understanding a country's economic health. Key data released like gross domestic product or GDP, employment data, inflation rate or CPI, and manufacturing activity or PMI can move currency markets. Positive economic data often strengthen currency, while negative data can lead to depreciation. Here's a tip for you. Stay updated with the economic calendar to know when important data releases are scheduled and their potential impact on the forex market. The second is central bank decisions and monetary policy announcement. Central banks with immense influence over currency value through their interest rate decisions and policy statements. Traders closely monitor central bank meetings and press conferences to curve future policy directions. Here's a tip for you. Pay attention to the language used in central bank statements, as subtle changes involving can indicate shifts in policy stance. The third, geopolitical events and political developments. Geopolitical events such as election, trade disputes, and diplomatic tensions can cause volatility in forex markets. Political developments and changes in leadership can also impact a country's economic policies and currency values. Here's a tip for you. Stay abreast of international news resources to be aware of geopolitical developments that can affect forex trading. The fourth is a natural disaster and economic crisis. Natural disaster and economic crisis can disrupt economies and affect currency values. Traders should be vigilant about events like earthquakes, hurricanes, financial meltdown, and debt crisis. Here's a tip for you. Diversify your portfolio and implement risk management strategies to safeguard against unexpected market upheavals. The fifth is trade agreements and tariff changes. Trade agreements and tariff modification can significantly impact international trade and currency values. Announcements regarding trade deals and escalation in trade tensions can influence currency pairs. Here's a tip for you. Consider the implication of trade-related news on countries' economies and their respective currencies. Number 6. Commodity price and commodity markets. Commodity prices, especially oil and precious metals, can affect forex market. The currency value of commodity exporting countries are often sensitive to changes in energy prices. Here's a tip for you. Observe the correlation between commodity prices and currency pairs to make informed trading decisions. And 7. Market sentiment and risk appetite. Investor sentiment and risk appetite have a substantial influence on currency flows. Events that impact global sentiment such as stock market crashes or economic slowdowns can affect forex trading. Here's a tip for you. Monitor broader financial markets and consider the overall market sentiment while planning forex trades. The last kind of news is black swan event and unexpected incidents. Black swan events are unforeseen and highly disruptive occurrences that can catch the market off guard. Examples include pandemics, terrorist attacks, or extreme market manipulations. Here's a tip for you. While impossible to predict, maintain a cautious approach and consider the potential impact of such events on your trading positions. Okay, the discussion about news that matters mark up the end of this video. Hopefully you can understand what I'm saying and can implement this knowledge in your trading. See you in next video.